Hey, what's up, everybody? Welcome back to Investing Sucks. So, high-end retail stocks have been getting crushed lately. We've got Nike stock here, which is down roughly 30% year to date, and we've got Lululemon stock, which is down about 41% year to date. So, naturally, when you have a lot of companies that have historically been very strong companies and they have traded at pretty high valuations, start to come down in price and start to look relatively cheap, you get all of these so-called value investors that come out of the woodworks and start giving their reasons for why they think that the market is wrong, this is an overreaction, and why you should get in now while you still can, which may very well be true. But whenever we see many companies in a specific industry starting to look cheap, some alarm bells do start ringing in my head, right? The reason being is because if a whole industry is starting to look cheap, there's probably a valid reason for it, right? So the topic of today's video is going to be Lululemon stock specifically and whether or not I think they present good value to investors right now. So without further ado, let's just dive right in. So, as far as apparel companies go, Lululemon has historically been one of the strongest companies out there. Probably the most important metric you would use for assessing these kinds of companies is this one right here, return on invested capital, right? And this is your best barometer for overall business quality, right? How much does the company get back in after-tax operating profit relative to the assets that they have invested in the business? And we can see for Lululemon currently it's about 23%. If we look at what it's been historically, it's always been above 20%, right? Even getting as high as 30% in some cases here. So that is pretty strong return on invested capital overall, especially relative to the industry median, right, which is about 12.5%. Now, as well, profit margins across the board are consistently higher than their competition, right? Gross margin 57% versus the industry median 41, operating margin about 20% versus the industry median of 9, so on and so forth, right? And they've been able to do this without having to take on excessive debt because if we look at their solvency ratios over here, these are much lower relative to the industry median as well, which is a big deal, right? Because that de-risks the company. And we add into the fact that they are still growing their revenue very fast, right? We take a look at their annual income statement over here. Here's the percentage year over year change in revenue. It's consistently been in the double digits and even a bit higher in some of the more recent years here. And they're currently expanding pretty rapidly into China and a handful of other countries as well. And not only that, but their operating margins are expanding too, right? We can see about 17, 18% in the mid 2010s here, all the way up to 2023, where they're actually getting close to 23% operating margin, right? So this is objectively a very high quality company. And the short answer for why they've been able to do this is because they have a very strong brand that makes high quality products that customers really like. That's really what it boils down to at the end of the day. And then you add in the fact that the market they operate in, the athleisure market, is expected to grow just under 9% annually over the next couple of years, right? So this is definitely a high quality company. Now, what's usually the catch with high quality companies is, well, they're usually pretty expensive, right? Which is still the case with Lululemon even after that 40% drop, right? They've got a price to earnings ratio of about 31 versus the industry median of about 13.5. Price to sales, price to book, enterprise value to EBITDA, it's all consistently above the industry, right? Because it's a higher quality company, right? Investors are willing to pay higher prices for their earnings because they perceive it to be a safer, a higher quality investment. So this scenario does remind me of that classic saying from Warren Buffett and Charlie Munger, which is that it's better to own a wonderful company at a fair price rather than just a fair company at a wonderful price, right? And the reason being is because over long periods of time, stock returns do generally correlate with what a company's return on invested capital has been, right? And I can show you this is the case for Lululemon, right? Return on invested capital, we can see it's fluctuated a lot, but right, the lowest it's kind of gotten is the low 20% range, right? And what has Lululemon's returns been over the last 10 years? Well, we go back to their stock price chart. Over 10 years, about 20% return per year, right? So the two do generally correlate. Even if you invest in the company at a slight premium, if you hold for long periods of time, generally these are going to be the same, right? If you're holding for 10, 15, 20, 25 years. So now the next task that we have as investors is to determine, is Lululemon still a wonderful company and is it trading at a fair price, right? And I want to start by going over why they went down so much initially. And this all started when their Q4 release came out earlier this year. That's where most of the drop happened. And what they said was pretty generic, right? They basically just said that US consumers aren't spending as much as they used to, right? They're being a little bit more cost conscious. And they also said it was partially due to product decisions that they made, which is very normal for a clothing retailer, right? This happens all the time. Sometimes they just simply don't have the product on stock that the customers actually want, and their sales suffer a little bit because of that. But it could also be due to macroeconomic concerns pertaining specifically to the US, right? So then in the next quarter, this was Q1 2024, they reported flat comparable sales for the Americas region, right? And this was pretty unexpected, and it is a problem for them because the US, or the Americas more broadly, is their largest market, right? About 75% of their revenue comes from there. So what I think is this could mean two things, right? One, is they're just a victim of their macroeconomic environment. And it's another example of a consumer cyclical company that's starting to hit the low point of that cycle. Or two, the brand is starting to weaken a little bit in the US and competition is catching up. Now, personally, I think it is probably both of those things. And initially, when I was reading what management was saying over here, it didn't really seem like that big a deal because their international growth was still very strong and they were still opening new stores in the US as well. So they're going to get at least some growth from that, at least, a high single digit growth per year just from opening new stores in the US, which they're still doing. But then I reminded myself, well, yeah, I mean, that's what management is talking about. Obviously, they're going to cherry pick certain data points that paints a nice picture and makes things seem better than they actually are. And they're just trying to convince you that everything is fine, right? So you do have to kind of go out of your way to understand the whole story. So then we go, okay, well, if it's just the macroeconomic environment that's causing problems for them, we should see this in other companies too, right? Because all companies are subject to the same macroeconomic environment in the United States if they operate in the United States, right? So we raised the example of Nike before. Nike is very similar to Lululemon, I think, because they kind of operate in that high end space of the overall like retail market, right? Even though Nike's more so known for footwear, whereas Lululemon is clothes, they're still pretty similar, I think, where they're more high end products. And they said something very similar. In their most recent quarter, they went down a lot because their revenue growth was essentially flat. And they said mainly due to macroeconomic uncertainty and also worsening foreign exchange, right? So Nike is kind of similar to them. But what about more discount clothing retailers, right? Specifically in the US. So we'll look at TJX, right? So TJX, for those who don't know, is the largest clothing retailer in the US. You're talking about a $100 billion+ company, and they operate more in the off-price retail space. So these are cheaper products, right? This isn't Lululemon prices, these are more discounted products. So what did they say in their most recent quarter? Well, comparable store sales increased 3% and was entirely driven by an increase in customer transactions, right? So that's interesting. It wasn't because they raised their prices, it was because customers are spending more at their stores, right? Again, this is just one company. Let's look at another similar company, Ross Stores. Okay, another very similar company, the second largest apparel retailer in the United States. Exact same. Comparable sales were up 3% versus last year in their most recent quarter. Another example, Burlington stores, right? Very similar, more cheaper products, not as expensive as Lululemon. Comparable store sales increased 2%. And all these companies, in terms of their stock prices, are doing quite well. So, quite well this year. So, what does this tell us? Well, it tells us that these macroeconomic concerns that they're talking about is probably more so just people being more cost conscious, right? People don't want to drop $150 on a pair of pants anymore. And it does make sense, right? Because inflation has been well above 2% for quite some time now. Interest rates are now higher, so those who have mortgage payments are having to cut back on spending in other areas. And we tie all this in where we look at one key data point. This is an economic data point, the personal savings rate in the United States. And this is over the past year. It's come down quite a lot, 5.2% in April 2023. It's come all the way down to 3.6% as of April 2024, which is the most recent time they reported it. Now, if we look at what this has been over the last 5 years, it looks a lot worse because back in these days, this was the stimulus check days. So the personal savings rate was historically high. We can even look at, the max it's been over the past 70 years, and it's never been higher than that, right? So it's really only useful to look at how things have changed over the past year. So simply put, Americans aren't saving as much money now as they were about a year ago. And you may think, well, this is just one data point, right? How does this one single data point mean that much for Lululemon? This can't really be that big of a deal. But keep in mind, Lululemon is a very large, multi-billion-dollar company that is highly exposed to the American consumer. That's where most of their stores are there in America. So any small change in the health of that consumer will flow through to the financial results of Lululemon. And then you add in the fact that there is starting to be some concerns about competition as well. Now, this is a big question mark, right? Because no one really knows what's going on with competition, and consumer tastes in the fashion industry are notoriously hard to predict, right? I personally find it difficult that the athleisure market, which has been very consistently growing for over a decade now, is just suddenly going to change on a dime and people aren't going to like Lululemon anymore. So I think this whole competition, um, dynamic that we're seeing play out, I think this is more so could be due to the macroeconomic factors as well, right? People are starting to buy cheaper products, which may look like, cheaper products are kind of building market share, but it's really just because of a change in customer taste. Because what Lululemon said in their most recent report was, foot traffic in their stores is actually up, but conversion rates, the amount of people that are actually spending money in their stores, is down a lot. So that tells you people are still shopping there, but they're just looking at the prices and saying, I probably shouldn't. Okay, so the last thing I want to cover is an actual valuation of Lululemon stock. And to do this, we're going to have to project out how much revenue they're likely going to earn over the 5 periods that I want to project here, and what kind of margin they're likely going to earn on that revenue. So I'll start with how I did the revenue growth, because those two, revenue and operating margin, are the two most important inputs that's going to go into an actual valuation model, right? If we're to do a discounted cash flow model. And the whole goal is to try and determine what is one share of Lululemon stock approximately worth given fair but reasonable assumptions for the next 5 years, right? So that's the goal of what I'm trying to do here. And the three assumptions that went into projecting their revenue out here. So you can see I kind of broke it down by the different regional segments they have: Americas, China, and then the rest of the world. So there were three key assumptions that went into this. One is the comparable sales growth rate, which I split out between the three different regions and also changed it depending on the year. And we can see basically in the Americas, I'm saying 0% throughout 2024, and then a slight increase in the future years, right? And then there's a much higher rate of comparable sales growth in China and the rest of the world. So I basically assume that this is going to stay high, but taper off slightly as the years kind of go on. And the new store openings, I think this is a very conservative assumption overall. So we've got the Americas here, which I basically took their guidance that they gave in the most recent quarter, took the low point of that guidance, and then basically kept it the same with a slight increase here in the Americas going forward. So this is a pretty conservative assumption based on how many stores they're probably going to open. And then the last one is how much additional revenue do they get per new store that they open on an annual basis? And this is just based off of historically what they've reported. They do actually break out when they talk about their growth in revenue year over year, how much was due to new stores that they opened. So you can get a pretty good understanding of, for the different regions, how much additional revenue gets added per store, right? And it seemed to be about these numbers here. So then once we have all these projected for revenue each year, you basically just take revenue, what it was last year, multiply that by 1 plus the comparable sales growth rate, plus the new stores that they're going to open that year, multiplied by the additional revenue that they're going to get per store. So this is the revenue overall. We get about $10.5 billion in 2024, which does align somewhat with the guidance that they've given. And this grows all the way to just under 16 billion in revenue by 2028. So overall, that's about 10.5% revenue growth per year, which is, as we saw before, much lower than what it's been historically, right? But I'm comfortable with this, right? It is conservative, but it's a reasonable assumption. And it gives us something to base the future performance of this company off of. Now, what about margin, right? This was pretty easy to project. I'm really just going to go off of what management has guided here. Now, operating margin has been increasing over the years, right? If we compare to, it was kind of decreasing for this period here, but then 2016, it's been gradually expanding over the years, and it's getting to a point now where it's kind of in the mid 20% range. And they basically said that they expect a slight expansion in their operating margin to about 23% for the full year of 2024. And then in this plan, they have their Power of 3 times 2 plan. They're tracking slight expansion of their operating margin, which is what I projected here, right? Basically, slight expansion of the operating margin as the years go on. So I'll put this into a DCF now, and I'm going to use a feature that I built on my website, which By the way, if you're wondering about this website, it's a free website that I created. It's called tickernomics.com. Link is in the description if you would like to use it for yourself. But this is the value of stock feature. It basically does a discounted cash flow for you. So I'll put in Lululemon and we get all our assumptions here. So we're doing a 5-year analysis. I'll change the revenue growth to 10.6%. Operating margin will do slightly above 23%. The tax rate I'll leave the same. CapEx, they did give some guidance on this, so this is going to be a bit higher, 700 million per year. And then I'll also increase the depreciation amortization. I'll leave all these items the same, except I have to adjust this. So they have about $2 billion in cash on their balance sheet. Last assumption I want to change is what to use as a terminal multiple, right? This defaults to 10, but for Lululemon, they're usually much higher. They're going to be higher than their competitors because, again, it's a high quality company. Currently, Lululemon, as we can see here, they have an EV to EBITDA ratio, which is the terminal multiple I'm using, about 18.5. So I'll go slightly more conservative and just use 15. And then our cost of capital automatically calculated here at 9.15%. So those are all the assumptions that go into it. We'll calculate it. We can see we get an intrinsic value per share $373 versus the current price of $300. So based on this, based on what I think are reasonable, supportable assumptions for Lululemon over the next 5 years, it does seem to be slightly undervalued, right? It's not significantly undervalued, but it's slightly undervalued. And what this tells us is it's still a growth dependent valuation overall, right? Investors are still expecting this company to grow. Obviously, not as much at the start of the year when it was $500 per share, but there is still is some growth built in. Because let's say the Americas region, goes really bad. Like let's say it's 0% next year, but even we could say -1% over the years, right? We can change this. That updates everything else. And now instead our revenue growth rate goes to 8%, right? So what happens if instead of 10.6, we have 8% revenue growth? So we'll change that, calculate DCF again. Still a little bit undervalued even at that price. That basically took off about $30 per share in intrinsic value. So the reason I'm showing you this is because this shows how you can kind of understand how investors are valuing this company. You can look at the assumptions that are built in at this current price and say, okay, I think it's overvalued or I think it's undervalued. And then you actually have something to go off of. So when Lululemon releases their financial results into the future, you can compare that to what you projected. And then you know whether or not, like, why the company's doing well or why the company isn't doing well. Now, that being said, I would still probably wait until their next quarterly results come out before doing anything, just because, you know, you're going to get some more clarity on the US picture, right? Because if they start to say comparable store sales are now growing, then it's a lot more clear versus you don't know what's going to happen next quarter. Things could get a lot worse. And as we saw here, it's still a growth dependent valuation. So anyways, guys, those are my thoughts on this company. I hope you did find this useful. If you did, then please leave a like. And if you'd like to connect with me directly, I have a Discord channel, which I'll leave in the link in the description of this video. And yeah, thanks for watching, and I'll see you guys in the next one.